Developing investment signals from capital markets research. There's a huge academic literature, probably going back 40 years or so. Paul's talked about the databases. Much of it emanates from the US. The databases sort of came online in the late 60s, so we've got about 40 odd years of academic research. Capital markets research, looking at anomalies, investment strategies. So there's countless signals out there in the market. Call them signals, call them factors, call them characteristics. I'll call them signals today. Lots of signals that have been explored in the academic literature. Lots of different methodologies used. Different methodologies, different time periods, different countries. The findings, some of them are consistent and pervasive across studies. Momentum is one that's been alluded to. Momentum seems to be found right around the world. So some signals seem to work consistently. I guess you believe them more strongly. Others are not so consistent. And when you find a signal that works in one country and not in another, or in one time period and not another time period, or with one methodology and not another methodology, perhaps you don't have as much confidence in that sort of signal. Probably at risk of stating the obvious, the objective functions of academic, scholarly researchers and investment professionals don't perfectly coincide. They're not identical. Academics, it's not uncommon that an academic will work on a research study for 3-4 years. They'll explore it to the nth degree. You know, they'll look at all the bells and whistles, all the robustness analysis. They send it out, and we have to do this. We send it out for publication, and it's reviewed by our peers, who will also scrutinise our work. So we're very concerned with making sure everything's in order, that it's very tight, that everything's been thought of. Say in contrast, an investment manager probably doesn't have 3 or 4 years to sit down and to study one little investment signal. They may not necessarily want to do it to the nth degree. Certainly it's not going to be peer reviewed. It's an interesting thing that academics will send their work off to their peers, their competitors in some respects, to see what the competitors think and to see if the competitors can pick holes in their work. So I'm not sure that a fund manager will send off to a rival firm to say, here's my signal, what do you think of that? So we have different objectives. So the question I want to talk to is what insights, if any, can a practicing fund manager glean from the vast empirical research, vast empirical literature that's out there. So that's what I'm going to look at. My view is that there's a huge potential out there to learn and to lever on the work that's already been done. And if you look at it, you've got very highly trained scholars. They're technically sophisticated and they have the luxury and the opportunity to spend years looking at these topics. So there's potential to lever on their work. At the same time, there's a danger, I think, of misinterpreting results that are published in academic journals, of over-reading them or over-extrapolating the findings from published research. So really, what I want to do is talk to how practicing fund managers may look into the academic literature and take away from it signals that are useful, while at the same time not falling into the traps that are all too common. So the two key takeaways, in all honesty, I hadn't seen Paul's slides before the presentation, but we're going to have, I think, a fair bit of commonality in the themes here. The two takeaways that I will talk to, first of all, you simply cannot presume that an empirical regularity that's documented elsewhere, and usually it's the US, so much of the research, so many of the top journals are US based in accounting and finance. You simply cannot presume that any signal or empirical regularity that's documented elsewhere will translate automatically into the Australian environment. That's a big danger. You may get a signal, you may get an indication of where to look from research in other countries, but it needs to be thoroughly tested locally. Secondly, even when the research is done locally using Australian data, keeping in mind that the objective function of academics and practitioners differ to some extent, even when the research is done locally, the sample used in an academic study will inevitably differ from the fund manager's, what I call the investable universe of stocks. And I'll talk to that. And so Paul has mentioned these points. I guess what my talk will do is put some examples and some numbers to these issues that I'm trying to highlight. Okay, so how do academics go about studying signals and the profitability of trading strategies? There are a couple of approaches. One approach uses regression, least squares regressions, to look at whether various signals are related to future returns. And there's benefits to that, there's pros and cons. But perhaps, and I guess that will give you a statistical indication of whether a signal is related to returns. Perhaps a more practical methodology, which arguably measures the economic significance, is what I'll call the portfolio sorting methodology. And like the regression approach, the portfolio sorting methodology is used in the academic literature, and no doubt it's used for a lot of back testing in practice as well. So it sort of goes like this. I'll see if I can work the pointer. There you go. So the portfolio sorting methodology, basically what we'll do is we'll take a signal and we'll sort the stocks that we have in our database according to the signal and form them into portfolios. Often it's 10 portfolios or 5 portfolios. So as an example, it might be you're looking at the size of the firm measured by market cap as a signal. You'll sort stocks from small cap stocks through to large cap stocks, slot them into 10 portfolios. Next, you look at the subsequent returns to those portfolios over a particular holding period, which might be, say, 12 months. And what we find in the example of the size anomaly is that on average, small firms outperform large stocks on average. Okay, and then finally, the magnitude of the trading profits will be established basically by comparing the two extremities, the portfolio of small stocks to the portfolio of big stocks. We might call this, in my slides I call them the spread portfolio. You may hear it referred to as the hedge, the long-short portfolio, the self-financing portfolio. I'll call it the spread between a high value of the signal and a low value of the signal. So as an example, these are average returns to portfolios formed on the basis of market cap in Australia using the population of stocks. And their monthly returns, so ranging from the small cap portfolio, 3.49%, and they sort of monotonically decrease. As you read from left to right, the stocks in the portfolios are going from small caps through to large caps. So as you go from small to big, the average returns are nearly monotonically decreasing from about 3.5% per month through to 82 basis points per month for the big stock portfolio. We would measure that in an academic study using the spread, the difference between 3.49 and 0.82. It's about 2.67% per month is the spread between small and big stocks. In these slides, the stars are just an indication of statistical significance. So the more stars, if there's 3 stars up there, that tells you it's highly statistically significant. Now, I work in this area, and whenever I form a portfolio and see a return in the magnitude of 3.5% per month, that's what, 40% per annum, I'm sceptical. I think, is it that easy to make money that I can just buy a bunch of small stocks and make 3.5% per month? I'm a skeptic. So to look into that, and this is an example of looking at the investable universe of stocks for a money manager. Paul alluded to this before, but there are unique characteristics of the Australian market that need to be taken into account. In Australia, there are approximately at the moment 2,000 stocks listed on the stock exchange. So if I was forming portfolios here, there's 10 portfolios, there's roughly 200 stocks in each portfolio. The top 200, that's them there, big stocks. The next one, portfolio number 9, that'll be stocks 200 through 400. And the key point is that this portfolio, that's roughly stocks 1800 through 2000. Now, I'm not sure if anyone in the room could even name a stock that's ranked, 1999 on the ASX at the moment. They're tiny, tiny stocks. And to illustrate that, these are the market caps, the average market cap of stocks going into each of these portfolios. So sure, at the big end, they're averaging 1.7 billion. Have a look at those. At the small end, the stocks in those portfolios are 3 million. So they're tiny, tiny stocks that have virtually no liquidity. They would trade very infrequently. When they do trade, it might be, a handful of shares here and there. So had we not looked at the size of the stocks going into those portfolios, you may believe that you can make 3.5% per month. As soon as you see the market caps, you realise that, well, realistically, you probably can't get a piece of the action there. And quite possibly, the investment mandate may not allow you to go anywhere near these stocks. If you're limited to the top 500 stocks, you're really looking at the big portfolio, number 9, and some of number 8. So in terms of a size effect, at face value looks impressive, 2.5% per month. But when you look at what you can actually invest in realistically, it's probably not going to be as impressive. So what I'll then do is basically just truncate my investable set of stocks. Instead of the population of stocks, 2,000 stocks at the moment, just look at the top 500. First thing I notice is that the whopping 3.5% there has disappeared. It's now a more typical 1%. So even with the top 500 stocks, there's the size effect has sort of dropped from 2.67 down to 31 basis points. It's not even statistically significant. As I look across these numbers here, there's not really a lot of difference between them. So really there's no size effect or size anomaly in the top 500 stocks. Now, would you invest in them? I mean, even then, you look at the market caps in this small portfolio, 24 million is the average market cap. So it's a very small stock going to that portfolio still. So maybe you won't even invest in the top 500. You might just be looking at the top 300 stocks as your investable universe. And certainly when I look at the final columns here, there's no size premium. There's no abnormal profits to be made here from investing in size. So that's an example of when research, even if it's done in Australia, I've seen plenty of studies which present results like that. I've seen studies done locally which will report average returns to the small stock portfolio in the magnitude of 7 or 8% per month, which is just nonsensical. And when you look into it more closely, you find that probably when you restrict the analysis to the set of stocks that could realistically be invested in this case, there's no size effect there. So this is going to be one of the key takeaways. Anomalies or regularities that are allegedly found in the population of stocks may not exist in the investable universe of stocks that a practitioner will be interested in. Some academic studies increasingly are starting to split the analysis up from the population to smaller subsets of stocks, but many studies still will just look at the population. So it's hard to extrapolate the results from there. So I guess the takeaway here is that a published study may provide a direction to look at, a signal of what variable or factor or characteristic to look at. There's going to be a lot of fine-tuning that needs to be done before you can have confidence that it's going to produce reliable returns. A few other quick ones. I've got 2 key points I want to make. That's the first one. Just to have a look at some of the other well-known signals that everyone's familiar with. The value premium, where stocks are sorted based on their book-to-market ratio. So these numbers here are spanning about 1990 through to 2011 is where my data cuts off. First of all, if you use all listed stocks, is there a value premium in Australia? Using the population, as we go from growth stocks through to value stocks, the average returns go from quite low through to the highest. So there's a value premium there of about 1% per month. So at the population level, yes, it looks like there's a value premium, but again, conscious of the previous slide where the size effect disappeared once I looked at the investable universe, the question would have to be asked, well, does the value premium exist in the set of stocks that I might want to be investing in? And as you move down, I'll jump straight down to the bottom. Even in the top 100 stocks, there's a very clear value premium there. The figures don't change much as I move down from all listed stocks, top 500, top 300, top 100. This is about 0.3 in each case, and over here it sticks around 130, 140 basis points. So that's quite strong evidence there for a value premium in the Australian market, that no matter which petition or subset of stocks I look at, there's a consistent value premium of about 1% per month, statistically significant. Momentum is probably the most famous anomaly. Certainly exists all around the world. In Australia, do we find it? We do. It's really strong. In the population, I might just go straight down to the top 300 or top 100, which you may be interested in investing in. Let's go to the top 300. The previous losers, and my strategy here is what Jagadish and Titman would call a 6-6 strategy. So I've measured price momentum or relative strength using returns over the previous 6 months. And then I form a portfolio from losers through to winners and hold them for 6 months. So here we've got the losers underperforming the winners by about 120 basis points per month. So again, that's consistent evidence there that in various subsets momentum exists. Asset growth is an interesting one. There's been a study in the US in 2008 that found that asset growth, so that's just the book value of assets, the percentage change in book value of assets is a signal, a reliable signal that low asset growth stocks outperform high asset growth stocks. I've had a look at that in the Australian context. Using the population of all listed stocks, there is an asset growth effect. Let me say that differently. Low asset growth stocks average about 1% per month. High asset growth stocks average only 27 basis points. There's about 74 basis points there. It's not statistically significant, which is a different result to what was found in the US. However, when I limit it in Australia to the top 500 stocks, it actually gets a bit stronger and the statistical significance kicks in there. So there's a danger to just using the population of stocks. Probably no one's investing across the spectrum. That's an interesting graph in terms of the asset growth. It's also interesting to have a look at across time. This is from 1992 through to 2011, the year-by-year profitability of trading that asset growth signal on an annualised basis there. And what you see is it's remarkably consistent for about the first 10 years or so, and then from 2004 onwards, it's a bit all over the place. Now again, a graph like that is useful in that if it's consistently positive, that gives you more confidence in the signal. The second issue, just quickly, and we've heard this a few times, but you can't simply presume that any empirical finding documented elsewhere will translate directly into the Australian environment. My component of the Platypus funded project is to look into and explore the Accruals anomaly, which has received a lot of attention in the US. Basically attributable to Sloan in 1996. Now, Sloan was an academic who went and worked for BGI as head of their quant research for about 5 years to explore signals like this. The Accruals anomaly basically says that stocks with low levels of accrual, and maybe you think of accruals as accountants doing journal entries and bookkeeping and maybe manipulating profits. Sloan found that stocks with low levels of accrual outperform stocks with high levels of accruals. Now we look at that first of all in Australia, and yes, there is an accrual anomaly in Australia. As I go from low accruals through to high accruals, the returns go from 126 down to negative 33 basis points. It's about 1.6 per month, highly statistically significant. So at face value, that sort of matches the US findings. Other studies in the US have looked at the components of accruals, changes in accounts receivable, accounts payable, inventories, etc., and found that the components of accruals each contribute to the overall effectiveness of that signal. So I set out, my task was to look at the components of accrual and see how it translates to Australia. I've got no results for it because there were no results for it. They didn't translate at all. So the studies in the US that have looked at the components of accruals That's a result that at our first run through here, it's just not translating into the Australian economy. I'll skip that one. I'll just go to the key takeaway. So the key takeaway here is, I think there's a huge body of literature out there, and there's plenty to be learned and plenty of directions to be given, but you simply can't just pick it up from a journal published in another country, in another time period with different accounting standards, etc., and think that it's automatically going to replicate itself in Australia. They won't translate, they won't necessarily translate directly. They need to be explored in Australia quite rigorously to see whether they are there. And then secondly, even for research, you may pick up one of the local journals that publishes capital markets research and see findings there and apparently profitable trading strategies. Even then, in all likelihood, the academic study is using the population of stocks, roughly 2,000 stocks on the Australian Stock Exchange. And to the extent that the spread portfolio, the extreme portfolios are driven by small stocks that you probably wouldn't or couldn't trade effectively, then the signal may not exist in Australia. So the research will provide you guidelines and directions for where to look, but they do need to be, I think, thoroughly road tested in the local scenario under the investment mandate that you might be working with. Thank you.
Any questions for Phil? Well, I think you all deserve